Meyer is the chief economist at Mastercard Economics Institute and joins us now. Michelle, fantastic to have you with us. Your sense on these numbers, the consensus seems to be that this doesn't change the ability of the Federal Reserve to cut interest rates next week.
I think that's right. I mean, as you noted, Julia, it's a little bit of a mixed picture when it comes to the inflation data. On the one hand, you did see a little bit of an increase in categories that had been showing some real disinflation, including food. Some other goods categories did tick up a bit. But the encouraging part of the report was that easing in rental or housing related inflation, which has been the stickiest part of the inflation basket and really the part that the Fed was waiting on to feel very confident that they can continue to see a path lower for inflation. So it does seem like it's setting up for the Fed to be able to deliver as the market is expecting next week for an additional 25 basis points of cuts.
Yeah. I mean, 40% of the overall gain for shelter prices or housing costs, and we've seen that as high as 90% of the gain, just for context. So we've seen interest rates from the Federal Reserve come down a little bit. Wages, on average at least, have more than caught up, though of course it's been very painful for people. The jobs market remains strong. It sort of ties to your spending survey, which shows a resilience in consumers, even as consumers seem to be more strategic in their purchases, more sort of mass products rather than luxury, for example. Just talk us through what you're seeing from the consumer.
Absolutely. I think it very much ties to what you had mentioned, Julia, in terms of the labor market, which is strong. We are still seeing an economy that is net adding jobs, an unemployment rate that is close to record low levels, and wage growth as a result that is running in a mid 4% pace, which is above underlying inflation for goods and services. So there's real purchasing power out there, which is important for driving consumer spending, particularly at this critical time in the holiday season. And we have the ability to see that in real time. So we're able to track and look at spending trends on a high frequency basis, on a hyper local basis. And we are seeing consumers engaging during this season, particularly during periods of promotion. So this Black Friday weekend was really critical. And we did see a lot of particularly e-commerce spending during this period of time.
Yeah, so we're seeing strategic spending, as you said, promotional spending, and people looking for bargains, which makes sense. Do you think if we take a step back, we're still underestimating the underlying strength of the US economy? Because I have seen a lot of debate since the inflation number and since the Black Friday spending that I know you're mentioning too, that perhaps this could be sort of a final cut, at least for now, from the Federal Reserve. Is that people getting too excited, or is that a risk based on the underlying picture of the economy?
Look, I think that many folks have underestimated this business cycle this whole time for the past several years, looking for the cycle to turn, looking for that weakness to show up, and being surprised when the economy not only grows at trend, but above trend. If you think about how we're tracking for this year, real GDP growth looks like it's coming in at 2.8%. Last year, we had 2.9% GDP growth. So it's an economy that is running still in a robust pace. And I think a lot of that owes to the fact that the US consumer has really been able to engage in this cycle. So as we look ahead, we're paying a lot of attention to trends in the labor market, trends in consumer spending, how we're seeing the momentum play out and what that means for inflation. I do think that we're in an environment where inflation should continue to cool, particularly for goods where consumers are looking for those promotions or looking for those deals. And I think that's helping to generate a demand side push towards lower prices. But at the same time, with the labor market continue to expand, wages running above underlying inflation, there's a limit to how much inflation will come off of these levels. And I think that's exactly what the Federal Reserve is trying to balance right now.
Yeah. And I guess the biggest wildcard from now is perhaps, at least in the next sort of 6 to 12 months, what happens with tariffs. Do you think some part of the underlying strength that we're seeing is brought forward consumption as people perhaps anticipate prices being more expensive, or is that too fanciful because we simply don't have enough information yet on what the next administration will mean and bring in terms of tariffs, despite the threats?
I think there are a lot of uncertainties and a lot of questions on exactly how policy will play out next year, whether you're talking about trade policy or other types of fiscal policy. So the timing is unknown, the degree of tariffs is unknown. So I think it's really hard for consumers in particular to plan properly, knowing what the future price might be. That said, a lot of companies are looking to be proactive. And if you look at the import data from the Census Bureau, it has shown an increase in imports for the last few months. And that trend could continue as companies look to build some inventories and stockpiles, given the uncertainty around the path forward for trade. But I think what we're seeing today in terms of consumer spending is really based off the fundamentals in the economy, which has been continued job creation, continued wage growth.
Yeah, that was a perfect tease for my next segment, by the way. Michelle, great to chat to you. Thank you so much for your insights, Michelle Meyer there.